Hi folks, Scott here, and this is the wrap for Wednesday, September 25th. So this is my workspace for back testing. I'm actually doing a webinar here in less than an hour showing off our tools. So hopefully most of you that are listening to this checked it out this afternoon. Regardless, what this is a 5-minute chart scrunched up, so you can see about 10 days worth of data with above a daily chart. I've used the cash index, a little bit more accurate for closing prices, and I'm going to show you the results of fading gaps after 4 consecutive lower daily highs. So I doubt seriously we're going to rally 10 points here into the close in the last 20 minutes. So lower high, lower high, lower high, and lower high. So 4 consecutive lower daily highs when above a 200-day moving average. So just building upon the concept I showed in last night's video. And there you go. 2-to-1 odds of gapping up on the subsequent day, so that would be tomorrow. And using an end of the day stop, it's only been about a 50-50 trade and has lost a bunch of money. So it's had a 0.6 profit factor. You see the losses, cumulative losses here from the 20 losing trades right there using 10 contracts. And the winners were just much smaller, about half the size. So clearly pressures to the long side in terms of which way we're likely to gap and which way we're likely to trend, I guess. And actually that's not a fair statement because that's just targeting gap fill using an end of day stop. But I'll rerun these numbers for our members in the morning. In fact, I may just run this in my demonstration webinar. I probably will, actually. We'll look at what happens when you just use an end-of-day target and an end-of-day stop. See how these numbers change going into tomorrow. Okay? Might even favor a follow-the-gap scenario. And a down gap looks on the surface to be attractive. I'll need to rerun it with our MTG stop parameters to confirm its tradability, though. All right, going into today, it was sort of a similar scenario that we have got going into tomorrow. Let me show you the worksheet, how it was set up. We end up with small gaps and mixed directions and zones, and clearly you can see there's a little bit better odds for gapping down than gapping up. Right at a glance, these are the two opening areas above the high, between the high and the close, versus two up opening areas versus two down opening areas between the close and the low and below the low, which had slightly better numbers, no unique day factors, and one unique pattern from our database following a 10-day moving average down straddle. So that's when you close below the 10-day moving average after closing above it, but still above the 200-day moving average. And as a reminder, the definitions for these patterns are always shown down here. So that had a slight bias for the long side as well. Let me show you my comments. As I showed in last night's video, the data was definitely stacked to the long side there. That was after 4 consecutive red candlesticks. I misspoke. So what I just showed you was 5 consecutive lower daily highs. Similar concept though, right? And you see it was stacked favoring the long side, fading non-cowboy gaps. So those are defined in our members download area, but basically simply a DOC zone opening below the low of 2 days prior. So basically telling you the momentum, while you may have closed down below the open the prior day, the momentum's sort of gone because it didn't trade in such a way that it closed well below the prior lows. And that has been very bearish for shorting up gaps. So cowboy zones, or the DOC zone I should say, normally a good zone, but definitely not in this case. And so overall, they were mixed. So you can read it. Neutral to slightly attractive for up or down gaps, but in general, these unique factors here and from the worksheet clearly favor the long side, as I just showed you. So I said markets are poised to potentially bounce, and that's more of the same going into tomorrow. So it'll only fade the open with reduced size if the ES opens down below its 4 p.m. close. So that means whenever you see something like that, it means I want to make sure that the spider is also gapping down, and 2 of the other 3 future markets are also opening down. Now I clarified in the trading room right after I made the statement and made this post, and this is one of the benefits of being in the trading room, that I needed one of the ETFs to be trading, 2 of the other 3 ETFs to be trading down too. I should have clarified that. Because in general, small gaps with mixed opening zones are just problematic, as I've shown many times in the past. And I'll hold at least half the extended target area. Well, it was a good plan. problem was we didn't open with a big enough gap, which was actually okay because it sold off afterwards and would have stopped me out. That's why I have plans. I don't want to risk for a tiny small gap down getting stopped out. It's just too easy to be stopped out with those mixed opening directions. So in fact, you see the Russell gapped up and it sold off and filled its gap, kept trucking. Same with the NASDAQ and same with the Dow. Whoops, that was yesterday. Same with the Dow. So no trade for me. I did one discretionary trade when we got down here near the lows, and I got stopped out. I thought it was going to be buffaloed on that Chaikin volume spike there, but ultimately it would put in one more low before rallying. And I decided not to do anything else because the range guys just didn't show an edge for either or any direction, long or short. Though I was very tempted on the long side. I'm glad I didn't jump on that train because that would have been a mistake. So a quiet day. Pressure is definitely building, and we'll see what tomorrow brings us. And there you go. That is the wrap for Wednesday, September 25th. Have a great one.